Okay, when you're finally ready to jump into real estate investing, you probably imagine, getting those keys at closing, maybe that first rent payment hitting your account.
Hmm.
What you likely don't picture is that monster document, the purchase and sale agreement. It's just pages and pages of dense legal text.
It's intimidating.
Oh, absolutely. It feels like the biggest hurdle, the legally binding centerpiece of the whole thing.
Mhm.
And honestly, signing it can feel like a leap of faith for a lot of people.
Because who really reads, let alone understands every single clause in there?
Exactly. But here's the thing, signing that contract without grasping the world around it,
Yeah.
the financial architecture, the legal safety nets, the operational realities, that's where the really big mistakes happen, potentially catastrophic ones.
Right. So our goal today isn't actually to dissect that contract line by painful line. Instead, we want to equip you with the crucial knowledge about the system surrounding that contract.
We're aiming to translate the complex stuff, finance, tax rules, legal structures, into plain English. So when you do sit down to sign, you're not just nodding along. You're an informed investor. You know the sophisticated questions to ask your agent, your lawyer, your accountant.
Precisely. We've gathered a pretty robust set of sources for this deep dive. We're looking heavily at investment thinking, the mechanics of finance, and those legal frameworks that often decide if a deal succeeds or fails.
Okay, so where do we start? Maybe with the investor's mindset, understanding why real estate is seen as such a powerful wealth builder.
Sounds like a good plan. Let's calibrate that mindset and look at the dynamics of the market itself first.
Okay, so our sources are pretty clear. Real estate can be an accelerated path to building wealth, often much faster than, say, just putting money in stocks or bonds. Why is that? What makes it faster?
Well, a lot of it comes down to how the system is set up. The financial rules, the tax code, even the legal structures, they're kind of engineered to reward property ownership, especially for those who understand the rules.
How so?
The big one is leverage. Real estate lets ordinary people borrow significant amounts of money against a relatively small down payment. Think about it. You control a large, potentially appreciating asset with only a fraction of its value invested up front.
Right, you can control a $300,000 property with maybe $60,000 down or sometimes less.
Exactly. That leverage allows your wealth to grow at rates that are usually only accessible to, big institutions or the very wealthy. It sort of democratizes access to more sophisticated financial tools.
Okay, but let's be real about the flip side. Leverage is incredibly powerful, but it's also incredibly risky, isn't it? If the market goes south, that same leverage can wipe you out fast.
No question. It amplifies everything, gains and losses. Our sources define investment risk pretty simply. It's the chance that the returns you expect just don't show up. Specifically, the risk that the property value drops, potentially leading to a loss on your investment.
And in real estate, that risk isn't theoretical. The market moves in cycles.
Definitely. It has its ups and downs, booms, busts, and sometimes those really deep, painful downturns, the kind people call once in a lifetime, though they seem to happen more often than that.
We've certainly seen some wild market behavior, the dot-com bubble back in the late 90s, and more relevant for us, the housing crash around 2008. It felt like reality just got suspended for a while.
Yeah, those were classic examples of market irrationality. The sources really dig into this. They confirm that markets can become detached from fundamentals. Fear or just, herd mentality and euphoria can take over.
So what's the takeaway for an investor facing that kind of craziness?
The crucial lesson, the thing you have to hang on to, is that the market eventually corrects itself. It might take a while, often painfully slow, but true value based on actual income, actual economics will assert itself in the end.
So you can't just get swept up in the hype or the panic. You have to stick to the numbers. I think one source mentioned the firm foundation theory. Sounds a bit academic.
It does, but the idea is simple. It just means assets eventually circle back to their intrinsic value, which is usually tied to their ability to generate income like the rents a property brings in.
The net operating income, basically.
Exactly. You trust the math, not the noise. Your job as an investor is to stay rational, stay disciplined, even when everyone else seems to be losing their minds. You trust that the value you saw based on fundamentals will eventually be recognized by the market.
Okay, so if the market can be irrational and dangerous, you can't just rely on gut feeling. You need a system, right? A plan to navigate the volatility.
Absolutely. Success in real estate isn't random. It's not evenly spread out. Think about real estate agents. A small percentage of them make most of the money.
Why is that?
Because success takes work. It takes learning the fundamentals, constantly educating yourself, and crucially, it takes adopting a systematic approach. The advice from our sources is crystal clear. Buy with a plan. Don't just stumble into deals.
And buying with a plan doesn't just mean finding any house. It means finding the right house for your strategy, doesn't it?
Precisely. You need to target properties that align with your goals. If you're a buy and hold investor, that means finding a house likely to attract good, stable, long-term tenants. Is it the right size, the right condition? Crucially, the right location for that demographic.
Because just buying randomly might work out sometimes.
Yeah, you might get lucky. But having a plan, a system, means you're much more likely to make more money, make it sooner, and do it more reliably. Less guesswork, more predictability.
This idea of systems is so key. The sources use that analogy of Ray Kroc and the McDonald's, which I thought was really powerful.
It really is. Kroc didn't invent the hamburger, right?
Yeah.
He invented the system to deliver a consistent hamburger reliably anywhere in the world.
He knew the business had to work despite the individual franchisee, not because of them.
Exactly. He standardized everything: cook times, ingredients, equipment, service. That predictability was the genius.
So how does a real estate investor apply that? What does standardizing look like for us? We're not flipping burgers.
It means standardizing your buying criteria. What's your maximum price? What's your minimum acceptable return, maybe based on cap rate or cash on cash? It means using standardized lease agreements, having a standard process for screening tenants, one that's thorough and repeatable.
Like a checklist almost.
Pretty much. You should have systems for handling maintenance requests, collecting rent, tracking expenses. The goal is you could theoretically hand your operations manual to someone else, and they could run your properties effectively following your system.
That's the real shift, isn't it? Moving from hoping a deal works out to building a machine that produces results.
That's the difference between having a potentially profitable hobby and building a scalable, reliable, wealth-generating business. It requires that discipline, that systematic approach.
Okay, so we've got the mindset dialed in, think systematically, manage risk. Now we have to get into the nuts and bolts of evaluating a deal. Does it actually work financially? And that starts with two fundamental terms, NOI and cap rate.
Right. Net operating income, or NOI, is your starting point. It's the property's pure earning power. You take your total rental income and subtract all the costs of running the building.
So property taxes, insurance, repairs, management fees, utilities paid by the landlord, that kind of stuff.
Exactly, all the operating expenses. But, and this is a really crucial distinction where a lot of beginners slip up, NOI excludes your mortgage payment, specifically the interest portion.
Why exclude the debt?
Because NOI measures the performance of the asset itself, independent of how you, the specific investor, decided to finance it. Whether you paid cash or got a 90% loan, the building's operational profitability should be measured the same way.
Okay, so NOI tells us what the property earns on its own. Then how does the market decide what that income stream is worth? That's the cap rate, right?
That's where the capitalization rate, or cap rate, comes in. Now, a lot of people mistakenly think of cap rate as a measure of return, like your cash-on-cash return. But our sources really emphasize it's more a measure of market sentiment.
Market sentiment, how so?
It basically tells you how confident the overall market is about that particular property's income stream, its location, its future prospects. You calculate it by dividing the NOI by the property's current market value or sale price.
So if a property in a hot market is selling at, say, a 4% cap rate, what does that tell us?
A low cap rate, like 4%, means investors are feeling really bullish. They expect rents to go up, the property value to appreciate, and they see it as a very stable, safe investment. So they're willing to pay a premium, meaning they'll accept a lower initial rate of return for that perceived security and growth potential.
Okay, and conversely, if you see a property listed at an 8% cap rate, maybe in a less desirable area.
A higher cap rate, like 8%, signals the opposite. The market perceives more risk, maybe less potential for rent growth or concerns about vacancies.
Yeah.
So investors demand a higher immediate return to compensate them for taking on that perceived risk.
So the 8% cap rate deal isn't automatically better just because the initial number is higher.
Not at all. This is a key point. That property selling at an 8% cap could actually be a worse long-term investment than one selling at 6%.
How?
If that 6% cap property is in an area with strong job growth, rising population, consistently low vacancy rates, and maybe it just needs some minor cosmetic updates to significantly boost rents, its long-term potential could blow the 8% property out of the water.
So the lower cap rate might reflect better underlying fundamentals and future upside.
Exactly. The 6% property might offer much better total returns over time, even though its starting cash flow is lower. You have to look beyond the initial cap rate number.
Which means you absolutely cannot just trust the seller's marketing package or the pro forma numbers they provide. You need to do serious due diligence.
Oh, absolutely. You have to dig deep behind those glossy projections. Ask the tough questions. What has the actual vacancy rate been for the last 3, even 5 years? Not just what they're projecting or what it was last month.
Right. And why did operating expenses suddenly jump last year or drop?
Yeah, was there a major one-time repair driving costs up? Or maybe they dropped because they deferred necessary maintenance, which you'll now have to pay for. Are they underestimating future property tax increases or insurance hikes? You need historical data and realistic projections.
And the due diligence isn't just financial, is it? We need to look at the physical side, too. Environmental issues.
Definitely, especially with older properties. You need to consider things like lead paint, asbestos, maybe radon gas, underground oil tanks. Having an environmental checklist is really recommended.
Because finding those issues after closing can be a nightmare.
It can be incredibly expensive and create huge liabilities. You need to identify and budget for potential environmental remediation before you commit. Skipping this step is just accepting unknown risk.
Okay, navigating all this complexity sounds like you need a good team. Who's the most critical player to get on your side early on?
Hands down, your tax advisor, a good CPA or tax accountant who understands real estate. Seriously, don't skimp here.
Why are they so crucial beyond just filing taxes?
A good real estate CPA is looking at your entire financial picture, the forest, not just the trees of one transaction. They advise on the best legal structure for liability and tax efficiency. They help you strategize around depreciation, capital gains, 1031 exchanges. They literally help you decide whether you keep thousands or tens of thousands more dollars in your pocket.
And using a cheap or inexperienced one.
Can cost you far, far more than you save. It's a critical investment in your financial health.
Okay, CPA is number one. What's next on the team? You mentioned financing earlier.
Financing capacity is the gatekeeper, isn't it? Before you even spend time looking at deals, you need to know what you can actually borrow. Getting pre-approved, establishing relationships with lenders that become part of your team. Knowing your borrowing power dictates what deals are even feasible.
So let's talk about loan types. The most common is the conventional loan, right? Usually 30-year fixed, maybe adjustable rates.
Yeah, that's the standard mortgage from a private bank or lender. The main thing to understand there is the trade-off. A 30-year loan gives you lower monthly payments, which helps with cash flow.
But you pay a lot more interest over the long haul.
Exactly. A shorter term, like 15 or 20 years, means much higher monthly payments. That can pinch your cash flow. But you pay drastically less interest over the life of the loan and build equity faster.
So it's a strategic choice.
Yeah.
Prioritize cash flow now, 30-year, or long-term wealth and lower debt cost, shorter term.
Precisely. Depends on your goals and financial situation.
Now, for investors looking to grow, there's a powerful tool, leveraging the equity in their own home, using a HELOC or a home equity loan.
The home equity line of credit, HELOC, or home equity installment loan, HEIL or HELO. This is how savvy investors can essentially turn their primary residence into a funding source for down payments on investment properties. It's a really smart move, especially in competitive markets.
What are the advantages of doing that versus just getting a separate loan for the investment property?
Several key benefits. First, the loan is secured by your primary residence, not the new investment property. This keeps the debt structure cleaner on the new asset. Second, the lender for the HELOC typically isn't scrutinizing the condition or the specifics of the property you're buying with the funds.
They just care about the equity in your home.
Right. And the third advantage is huge in bidding wars: speed and certainty.
How so?
Having funds readily available from a HELOC allows you to make offers that look much closer to cash offers. You might even be able to waive the financing contingency. In a hot market, sellers love that certainty. It can make your offer stand out, even if it's not the absolute highest price.
Because the financing isn't dependent on the new property appraising or getting lender approval.
Yeah.
It's already secured.
Exactly. It removes a major hurdle and closing risk for the seller, making your offer much stronger.
Okay. Besides conventional loans and HELOCs, we sometimes see seller financing. When does that usually come into play?
Seller financing, or owner financing, typically happens when the buyer might have trouble qualifying for a traditional mortgage. Maybe they're self-employed with hard-to-document income, or they have some credit issues, or maybe the property itself has issues that make banks hesitant.
So the seller acts like the bank.
Essentially, yes. The seller provides the loan, and the buyer makes payments directly to them. The big benefit for the seller is they can often get a steady stream of monthly income, potentially at a higher interest rate than they could get elsewhere, and they offload all the headaches of being a landlord.
Because once the deal closes,
The property is 100% the buyer's responsibility. Taxes, insurance, maintenance, tenants, all of it falls on the new owner. The seller just collects the payments. It can be a really elegant solution for both sides in the right situation.
all right, we've found the deal, figured out the valuation, secured the financing. Now we need to protect the investment itself, right? And that starts with the legal structure, setting up an entity.
Absolutely critical. Forming a legal entity, most commonly an LLC or maybe an LP, is primarily about liability protection. You want to create a legal wall between your business assets, the investment properties, and your personal assets, like your home, car, savings.
So if a tenant slips and falls and decides to sue,
They sue the LLC, not you personally. Your personal assets are shielded. Now, there's a common misconception that forming an entity automatically gives you more tax deductions. That's not really true.
why not?
Deductibility is based on the nature of the expense. Is it ordinary and necessary for the business? Not whether it's paid by an LLC or you directly. The entity is mainly for liability protection, though it does help organize business finances.
Okay, so if liability protection is the main goal, what's the difference between setting up an LLC versus an LP, a limited partnership?
Good question. For most individual investors or small groups, the LLC, limited liability company, is usually the way to go. It's relatively simple to set up and manage, and it provides that liability shield to all the owners, who are called members.
And the LP.
The limited partnership is a bit more complex and typically used in larger deals, like syndications where you have many passive investors. In an LP, you have two types of partners: limited partners, LPs, and at least one general partner, GP.
And the liability protection isn't the same for both.
Correct. The limited partners, who are essentially passive investors providing capital, do get limited liability. But the general partner, the one actively managing the deal, has full personal liability for the partnership's debts and actions.
Whoa, so why would anyone be the general partner then?
Well, they retain control,
Yeah.
but to protect themselves, the general partner almost always isn't an individual person. It's usually another entity, like an LLC or a corporation, set up specifically to serve as the GP.
So it's a two-layer structure to get full protection while maintaining that GPLP control dynamic.
Exactly. It provides liability protection for everyone involved while clearly defining roles and control, but it's definitely more complex and costly to set up than a simple LLC.
Got it. So LLC for most individuals, LP for more complex syndication structures. Now, you mentioned expenses. What if the LLC doesn't have cash flow yet, say early on or during a vacancy? Can I pay for repairs myself and still deduct it?
Yes, that's an important flexibility. If the LLC is short on cash, you can pay for legitimate business expenses, marketing, repairs, insurance out of your personal pocket. The key is meticulous documentation.
Like keeping receipts and records.
Absolutely. Keep detailed records, invoices, proof of payment. Then you formally document that the LLC owes you that money back. When the LLC has cash flow again, it can reimburse you. As long as it's properly documented as a business expense and a reimbursement, it remains deductible.
Okay, that's good to know. Now let's talk about the really attractive stuff, the tax advantages unique to real estate. Depreciation seems like the big one.
Depreciation is huge. It's probably the single biggest tax advantage real estate offers over other asset classes. Essentially, the IRS lets you deduct a portion of the cost of the building, not the land, and certain improvements over a set period, 27.5 years for residential, 39 years for commercial.
Even if the property's actually going up in value.
Yes, that's the magic. It's a paper loss. The
Yeah.
IRS assumes the building is wearing out, even if market appreciation is making it worth more. This deduction is non-casher. You don't actually spend money each year on depreciation, but it reduces your taxable income.
So walk me through how that helps build wealth. Give me an example.
Okay, let's say your property generates $10,000 in positive cash flow for the year after all operating expenses and mortgage payments. But based on the IRS schedule, you get to claim $12,000 in depreciation expense for that year.
So on paper, you have a loss.
Exactly. On your tax return, you show a $2,000 passive loss, $10 cash flow, $12K depreciation. That $10,000 cash you actually received might be completely sheltered from income tax. That negative passive income can then potentially offset other passive gains you might have.
So you collect cash, build equity through loan paydown and appreciation, and potentially pay zero income tax on the cash flow.
That's the power of depreciation. It allows you to generate tax-advantaged or even tax-free income while your asset grows in value.
Well, there's always a catch with taxes, right?
Right.
What happens when you eventually sell the property? That brings us to capital gains and depreciation recapture.
Right. The taxman eventually wants his share. When you sell the property for more than you paid, plus improvements minus depreciation, that profit is generally taxed as a capital gain. Historically, long-term capital gains tax rates have been lower than ordinary income tax rates, which is good.
But what about all that depreciation you claimed over the years?
That's the recapture part. The IRS makes you add back or recapture the depreciation you previously deducted. That recaptured amount isn't usually taxed at the lower capital gains rate. It's typically taxed at a higher rate, up to a certain maximum, closer to your ordinary income rate.
So depreciation provides a tax deferral benefit during ownership, but you have to pay tax on that deferred amount when you sell. It's not a permanent elimination of the tax.
Precisely. It's a powerful deferral mechanism, but you need to plan for the recapture tax liability down the road.
Okay, this idea of tax deferral also plays into retirement accounts. Could you actually own real estate inside an IRA?
Yes, you can. It's called a self-directed IRA. And the rules are a bit more flexible than for typical employer-sponsored plans like 401ks, which are governed by stricter ERISA rules. So traditional IRAs, SEP IRAs, KIOs, and importantly Roth IRAs can potentially hold real estate investments.
But there are some significant trade-offs, aren't there? Especially with the traditional IRA.
Absolutely. The big drawback of holding property inside a traditional IRA is that you lose the main tax benefit we just discussed, depreciation. You can't claim those annual deductions.
Why not?
Because everything inside a traditional IRA grows tax deferred anyway. And worse, when you eventually pull the money out in retirement, all of it, your initial investment, any appreciation, any rental income is taxed as ordinary income.
So you might turn potentially lower taxed capital gains and tax-sheltered cash flow into highly taxed ordinary income in retirement.
That's the risk. If you expect to be in a high tax bracket during retirement, holding appreciating real estate in a traditional IRA might not be the most tax-efficient strategy.
Which makes the Roth IRA potentially more attractive for this.
For the right person, yes. With a Roth IRA, your contributions go in after tax, but then all the growth appreciation, rental income can potentially grow tax-free. And qualified distributions in retirement are completely tax-free.
And Roths have other advantages too, right?
Yeah, a big one is that Roth IRAs generally don't have required minimum distributions, RMDs, during the original owner's lifetime. This allows the assets to potentially keep growing tax-free for much longer, which can be a huge benefit if you plan to pass the assets to heirs.
Okay, so Roth can be powerful, but traditional needs careful consideration. Now, if you want to keep reinvesting in bigger properties and avoid that capital gains and depreciation recapture tax hit altogether, that's where the 1031 exchange comes in.
The Section 131 like-kind exchange. This is the ultimate strategy for deferring taxes as you trade up in the world of investment real estate. It allows you to sell an investment property and roll all the proceeds into a new like-kind investment property without paying any capital gains or depreciation recapture taxes at the time of the sale.
So you keep your equity working for you, growing tax deferred.
Exactly. It's how sophisticated investors build significant portfolios over time, moving from smaller properties to larger ones, deferring the tax liability potentially for decades, or even indefinitely until death, when heirs might get a step up in basis.
But these exchanges are notoriously strict. You mentioned two critical deadlines.
Non-negotiable deadlines. Miss them by a minute, and the exchange fails, triggering the full tax liability. First is the 45-day identification period.
Okay, what's that?
From the day you close on the sale of your old property, the relinquished property, you have exactly 45 calendar days, including weekends and holidays, to formally identify, in writing, potential replacement properties you might buy.
And you have to stick to that list.
Generally, yes. There are specific rules about how many properties you can identify, but you have to identify them within that 45-day window. Then comes the second deadline.
Which is?
The 180-day exchange period. You must actually acquire and close on one or more of the identified replacement properties within 180 calendar days from the date you sold the original property. Again, no extensions.
So 45 days to identify, 180 days total to close. Tight timelines.
Very tight, especially in competitive markets where finding and closing on a suitable property can take time. You need to be planning your replacement purchase well before you even sell the old one.
And there's another common trap related to debt, right? Something about boot.
Yes, this trips up a lot of people. To have a fully tax-deferred exchange, you generally need to ensure two things. 1, you reinvest all the cash proceeds, equity, from the sale, and 2, you acquire the new property with an equal or greater amount of debt than you had on the old property.
So if you pay off debt and don't replace it, that's a problem.
It creates taxable boot. If the mortgage you take on the new property is less than the mortgage you paid off on the old property, the difference is considered debt relief, and that debt relief is treated as taxable income in the year of the exchange.
You give a quick example?
Sure. Let's say you sell a property and pay off an $800,000 mortgage. You buy a replacement property, but you only take out a $750,000 mortgage on the new one, maybe putting more cash down. That $50,000 difference, $800K, $750K, is mortgage boot.
And that $50,000 is taxed.
Yes. That $50,000 becomes subject to capital gains and potentially depreciation recapture taxes in the year of the exchange, even if you reinvested all the cash equity. To fully defer, the debt on the new property needed to be at least $800,000 in this example. It's a critical detail to manage with your exchange accommodator and CPA.
Okay, we've covered the money side: valuation, financing, taxes, entity structure. But once the deal closes, you're not just an investor anymore, you're a landlord. And that opens up a whole new legal world, landlord-tenant law.
Yeah, this is where the day-to-day reality hits, and the rules are hyper-local. Every single state, and sometimes even cities or counties, have their own specific landlord-tenant acts. These laws dictate almost everything about the relationship.
Well, what specifically?
Security deposit rules, how much you can charge, how you have to hold it, timelines for returning it, rules about lease clauses, grace periods for rent, late fees, proper notice periods for entry or lease termination, eviction procedures, requirements for maintaining a habitable property. The list goes on.
And what's legal in one state might be completely illegal just across the state line.
Absolutely. You cannot assume anything. As the property owner, the business owner, the responsibility is entirely on you to know and follow the specific laws for where your property is located. Ignorance is not an excuse, and violations can lead to lawsuits and significant penalties.
So using state-specific leases and addendums is crucial.
Non-negotiable. You need legally compliant documents for your jurisdiction.
What about the tenant's responsibilities under these laws? What can a landlord generally expect?
Generally, tenants have a responsibility to, well, act responsibly. Practice basic housekeeping to avoid creating problems like mold or pest infestations. Treat the property with reasonable care. Don't cause damage beyond normal wear and tear. Report maintenance issues promptly. That's a big one. They need to let you know if something needs fixing.
And obviously pay the rent on time.
And pay the rent when it's due, yes. Those are the core obligations.
Now, on the landlord's side, there are protections for tenants too. Retaliation, for example. Landlords can't just punish tenants for asserting their rights, can they?
No, that's illegal pretty much everywhere. If a tenant calls the health department or a building inspector because of a legitimate habitability issue, the landlord cannot retaliate by suddenly raising the rent, starting eviction proceedings without cause, or refusing to make necessary repairs.
But that doesn't mean tenants have free rein if they complain, right?
Correct. The protection is against retaliation for exercising a legal right. A landlord can still absolutely evict a tenant for legitimate, non-retaliatory reasons like failing to pay rent, violating other significant lease terms, causing major damage, etc., even if they recently filed a complaint.
Okay. Which unfortunately brings us to the unpleasant topic of eviction. If a tenant stops paying, what's the process? It's not just changing the locks, is it?
Oh gosh, no. Self-help evictions like changing locks or shutting off utilities are highly illegal and will land a landlord in serious trouble. Eviction is a formal legal process. It usually starts with serving the tenant a specific written notice required by state law, often called a notice to quit or notice to pay rent or quit.
Like a 3-day notice, commonly.
Often 3 days, but the exact time frame varies by state and sometimes by the reason for eviction. If the tenant doesn't comply with the notice, pay the rent, fix the violation, or move out, within that period, the landlord then has to go to court.
File an actual lawsuit.
Yes, typically an unlawful detainer lawsuit or equivalent. You file the case, serve the tenant summons, potentially have a court hearing. Only if the judge rules in the landlord's favor will they issue an order, like a writ of possession, that allows the sheriff, not the landlord, to physically remove the tenant if they still refuse to leave.
And getting that initial notice wrong can derail the whole thing.
Absolutely. That first notice has to be perfect. Correct names, correct address, correct amount owed if it's for non-payment, correct reason, correct dates, and served exactly according to state law, personal delivery, posting, mailing, etc. Any mistake, even a small one, can get your case thrown out. forcing you to start the entire costly and time-consuming process all over again. Lost rent keeps piling up.
Wow. Okay, so assuming the tenant eventually moves out, either voluntarily or through eviction, there's still the security deposit to handle. How do you avoid disputes there?
Documentation, documentation, documentation. Assume every security deposit dispute could potentially end up in small claims court and prepare your case accordingly from day one.
What does that look like?
You need clear evidence. Move and inspection reports signed by the tenant detailing the initial condition. Detailed photos or videos before the tenant moved in and after they moved out, showing any damage beyond normal wear and tear. Itemized invoices or receipts for all repairs or cleaning deducted from the deposit. Copies of the lease highlighting the clauses that make the tenant responsible for those specific damages or cleaning costs.
So you're building a file to justify every deduction.
Exactly. You send the tenant a detailed, itemized list of deductions along with any remaining refund within the state-mandated time frame. Transparency and solid proof are your best defense against disputes and lawsuits over security deposits.
This whole operational side dealing with laws, notices, courts, documentation, it really drives home that earlier point about needing systems, doesn't it?
It absolutely does. Real estate investing, especially buy and hold rentals, is a business. And like any successful business, it requires robust systems to run efficiently and legally. Trying to wing it is a recipe for disaster.
And for many investors, especially as they scale, part of that system involves hiring a property manager.
A good property manager can be invaluable. They are your boots on the ground. They should know the local laws inside and out, handle the tenant screening, lease enforcement, rent collection, maintenance coordination, and, yes, the unpleasant task of eviction if necessary.
They also bring local market knowledge, right?
Huge value there. They understand the nuances of different neighborhoods, what rents they can support, what kind of tenants they attract. As we discussed, sometimes properties just a few blocks apart can perform very differently. A good PM understands that local context.
What should you look for in a good property management company? What systems should they have?
You want a company that is systematic themselves. Do they regularly inspect properties both inside and out? Do they maintain meticulous records, ensuring lease files are complete and compliant? Do they track key performance indicators like vacancy rates and, importantly, turnover time?
Turnover time.
Yeah.
How long it takes to get a unit ready for the next tenant?
Exactly. Every day a unit sits vacant between tenants is lost income. Efficient turnover cleaning, repairs, painting, marketing, leasing is crucial for profitability. A good PM tracks this and works to minimize it. They're essentially running your systems for you.
And having that reliable management in place frees up the investor
to focus on the higher level activities, finding the next deal, securing financing, managing the overall portfolio strategy. It allows you to scale beyond what you could possibly manage yourself effectively. It helps turn that hobby into that scalable wealth machine. #tag outro.
Well, we've covered a lot of ground today. We really dove into the landscape that exists around that daunting purchase and sale agreement. We started with the investor mindset, the need for rationality and systems in potentially irrational markets.
Then we broke down the core valuation tools like NOI and cap rate, emphasizing that cap rate is market sentiment, not just return. We stressed the importance of deep due diligence, moving beyond the seller's numbers.
We also navigated the crucial financing piece, conventional loans, HLOCs, seller financing, and the power of leverage, both good and bad.
And then the legal and tax architecture, choosing the right entity, like an LLC for protection, understanding the incredible benefit of depreciation, but also the sting of recapture, and of course the power of the 1031 exchange and its strict rules.
Finally, we landed on the operational realities of being a landlord, knowing your state's specific Landlord-Tenant Act, handling evictions properly, documenting security deposits, and the value of good systems and potentially good property management.
Right. The key takeaway really is that truly understanding and mastering that contract means mastering the context surrounding it.
It's not just about being able to read the jargon. It's about knowing what questions the jargon should prompt you to ask. Knowing about HELOC leverage helps you negotiate offer terms. Understanding 1031 debt rules informs your replacement property search. Knowing tenant law shapes your lease.
This knowledge empowers you, the listener, to have much more sophisticated conversations with your team, your agent, your CPA, your attorney. You're not just passively signing, you're actively executing a well-thought-out strategy.
You're prepared for the complexities, not just hoping for the best.
Exactly. You understand the risks and how to mitigate them.
So let's leave our listeners with a final thought to mull over. We talked about how markets eventually correct irrationality, and how risk is the chance your expected returns don't materialize. With that in mind, how might truly understanding that concept of risk change how you negotiate the contingencies? The inspection contingency, the financing contingency, the appraisal contingency in your very next real estate contract.
Are those contingencies just check-the-box items to get the deal done? Or are they real tools you can shape to protect yourself against a potential downturn in value or cash flow based on your deeper understanding of the risks involved?
Something to think about. Until next time on The Deep Dive.